What's happened today? Lehman Brothers have shut down its UK mortgage business. The Cooperative Group withdrew some of its mortgages to new customers, and there are rumours that Halifax might follow suit. This, of course, comes after First Direct closed mortgages to new customers yesterday. That's what we're talking about this evening on the programme. And to do that, being joined by Jonathan Davis, who's a chartered financial planner from Armstrong Davis. Hello, Jonathan.
Good evening, Phil.
And your perspective on renting or buying is?
That I wouldn't touch property with a barge pole right now.
Really?
To buy it, that's right.
And these people who you often hear the phrase, oh, it's dead money renting, I'm just throwing money up against the wall when I could be putting it into something I can eventually own.
It's dead money when prices are rising, but prices are falling, therefore it's live money.
And a rent's down, a rental price is falling.
First of all, rents didn't rise over the last 10 years like capital values.
They did go up
soared.
though, didn't they? I know that.
They went up a bit, but in the last 2 or 3 years they've actually fallen because there's been a massive surplus of buy-to-let properties.
So, take my one-bed flat, for example. Would I be able to rent it more cheaply than I'm having to pay the bank for the mortgage on it at the moment?
I think without a shadow of a doubt.
Fergus Muirhead's with us. He's a financial expert and journalist. Hello, Fergus.
Hi, Phil.
When I heard you were coming on the show, I thought it was only fair to sign the Members' Register of Interest and say you've actually given me some financial advice in the past.
Indeed I have.
And what do you think about renting or buying at the moment?
I think that we've become fixated and obsessed with buying property in this country, and I've always believed, and maybe because I suffered from negative equity in the early 90s in the north of England, but I've always believed that you buy a house to live in. If you make some money from it at the end of the day, that's all well and good, but fundamentally and primarily it's somewhere to live.
When you say you suffered from negative equity, I mean, surely if you've bought somewhere to live, you just have to hold on to it, don't you, and wait for it to go back up? Or is it not that simple?
Well, no, it's not that simple if you want to change your lifestyle and you want to move somewhere else because, you know, for a number of different life reasons. And that's what I decided to do, and therefore on that basis I took the hit. And I decided I would rather live somewhere else and deal with the fact that I'd lost money from it because my driving force wasn't to make money from the house that I live in. I think if you're buying other property, and Jonathan talked about the buy-to-let market, if you're buying property as an investment, it's a completely different story. But I think the house that you buy to live in, you should see fundamentally as somewhere to live and not somewhere to make money from.
Nick Cosgrove's here from 5 Live Money. Just run us through the economic picture of today then, because we had this First Direct news yesterday that was huge and all the papers led with.
Yes. Then we had the US investment bank Lehman Brothers withdrawing from the UK market. Now, they're small. Let's not be under any illusion. They've got two brands, Southern Pacific and Preferred Mortgages. Most people will not have heard of them, but they will have heard of the Co-op.
Yeah.
And the Co-op announced it's withdrawing its 2-year deals from tomorrow night. It is, however, still offering 3- and 5-year deals. So it's different from First Direct. Let's remember, First Direct withdrew its entire range of mortgages to new customers. But it's part of a wider picture here. Today, more than 500 deals were taken off the market, and the number of mortgages on offer has fallen by 40% in the last month, so there's a bigger picture thing going on.
Now, just talk me through some of the reasons, because last night, when we talked about First Direct, you said this was an administrative thing, there wasn't a lack of liquidity.
Yeah, and that's exactly what the Co-op is saying.
But with Lehman Brothers, this is a direct result of the subprime.
There are other... at the top end of the market, you've got the big players like First Direct and the Co-op, and what they're saying is, we've got no problem at the moment with the problems in the financial sector. We can raise money. The problem is that because other banks are having problems raising money and getting mortgage finance, they're withdrawing their offers and everyone's flooding to us. And the problem for us is that we cannot process mortgages quickly enough, and in order to satisfy our existing customers, we're going to have to take a breather by not offering new products.
But if everyone follows suit,
yeah,
and we've said in the introduction we expect Halifax to do it, and they're Britain's biggest lender.
Yes.
Then it's going to cause more panic, isn't it?
Well, it is. I mean, unfortunately...
And then what'll happen is, will it not lead to a cartel where you can only get your mortgage renewed with the people you're with?
I think it's too fast to say what's going to end up happening. But the problem is that clearly the Bank of England is cutting interest rates, and it's not having the desired effect at the moment because mortgages are becoming harder to find.
Fergus, panic begets more panic, doesn't it?
Well, of course it does, and you've even fallen foul of that yourself, to a certain extent. That when we started at the top of the programme, we said we've heard rumours that Halifax might be withdrawing some of their products, and we changed that a couple of seconds ago to we're expecting Halifax. So I think we just have to be very careful about the language that we're using here. It was the same problem when the Northern Rock panic spread at the back end of last year, because we had a situation where it was being reported every hour that there were queues of people standing outside Northern Rock branches. And what happened the next hour you reported it was that more people were standing outside the branches. And I think we've just got to be very, very careful. Jonathan talked right at the start about house prices falling. And I think that we're in a situation where lots of the media talk about house prices falling, where actually what they mean is they're not rising quite as quickly. So I think we're in a situation where it's very, very, very easy to use dramatic and emotive language, and that just helps to spread the panic.
Jonathan Davis?
Well, thanks, Fergus, for clarifying what I was saying. Actually, you've misinterpreted what I'm saying. When I said that house prices are falling, I meant house prices are falling. The Nationwide 5 months in a row has told us that house prices are falling. The issue that I want to clarify as well is that there's two really major mortgage issues here. One is the fact that a couple or 3 years ago, as I think was said, people could get mortgages at 4.5–5%. But because we're in a global credit crunch of literally astronomical proportions, even if the Bank of England's cutting interest rates, which they have done, mortgage rates are rising. So those who have come off their fixed or discounted rates now, 2 or 3 years later, are finding that the rates they've got with their existing lenders are through the roof. So the growth in mortgage demand has not been for people wanting to buy property, but for simply people wanting to move to another lender. Remortgages. Because we know for a fact that the number of mortgage approvals for house purchase have gone down 40% over the last year.
But
so
surely,
it's simply remortgages.
Surely, if people just stay put and stay calm for a moment, or a couple more moments, that it will even out, won't it? I mean,
I think you're making a vast assumption there. The fact is, everyone said that when the Bank of England cut the interest rates, therefore mortgage rates are going to fall. And clearly it's not, and the reason for that is it's not...
But it takes ages, doesn't it? Economically, in the cycle, it takes ages for us to see the repercussions of an interest rate cut, doesn't it?
It takes a year. On average, absolutely.
So there's been 2 recent cuts, hasn't there?
Well, the Bank of England has cut, but what matters is that the mortgage rates have risen.
Yes.
Not only for those coming off fixed rates and discounts, and also just normal mortgage rates. The Nationwide last week increased the rates by 0.5%,
so
even though the Bank of England cut by 0.5%.
So the lenders aren't passing the cuts on.
And why aren't they doing it? Because A, they've got no money, so A, they're requiring larger deposits for people to join them, and B, they know that they effectively have a cartel, so they can pretty well charge whatever they like. And let's face it, they're in business, why shouldn't they?
Let me talk to Nick, who's in Bradford. Hi, Nick.
Hi, Phil, yeah.
What do you think?
I think that the only way to do it is to own your own property. I think there's peaks and troughs, and at the end of the day, it's a 30-year investment, 25 to 30 years investment, and there's going to be peaks and troughs in that. And as long as you're not too greedy and overlook how we're now living in a global economy, and everything that happens in the world affects our market in this country. We're just a small country at the end of the day. If you want to rent something, then rent a car, because that depreciates. But property, from the dawn of time, over a 25-year period, will not depreciate. I don't care what anybody says, that's just not true. If you can stand the hit, and I've got a mortgage now for the last 10 years, I've got a fixed rate of 5.1%. I can afford that.
Jonathan Davis is shaking his head in the studio, Nick.
He can shake his head all he likes, but that's my opinion. I mean, I know everybody else has got their own opinion.
Yeah, I've got opinions. I've also got facts, and the facts are that 300,000 people lost their homes in the last crash, and we're already at higher number of repossessions than we were at the beginning of the same time in the crash last time. Mortgage rates are rising. We have higher levels of debt than we did per capita than we did 15, 20 years ago. You're absolutely correct. There's a time and a place for everything. This is not the time and a place to get involved in property.
But Nick's already involved. Nick's had his for 10 years.
Well, great. In which case, he will be able to retire comfortably. okay. But of course, there's a lot of people who bought 10 years ago who then remortgaged. There are a lot of people, hundreds of thousands, who borrowed in the last few years at vastly overinflated prices. And then you add on the hundreds of thousands of buy-to-letters in the last couple of years. These people are financially toast.
Do you own a place?
No, we sold.
So you sold your place and you now rent?
Yes.
And these things you must accept as cyclical, aren't they? So eventually,
and we're at the top of the cycle.
Yeah, but eventually it will come back round. And if Nick's point is he's going to hold on to his place because it's a roof over his.
I've already said that those who bought and with relatively low mortgages many years ago, they will be okay. I'm talking about the hundreds of thousands, indeed millions, who got into the mania in the last few years.
Let me talk to Alex, who's on the phone in Kent. Hi, Alex.
Hi there.
You're a letting agent.
I am indeed.
How's the rental market?
It's fantastic.
Well,
it's very busy and doing very well, thank you very much.
And what are the prices like? Are they up, down? Is it cheap to rent at the moment?
Well, it depends what you're looking for. I mean, I would say that generally they've increased by about 5 to 7% in the last year. But, you know, we've got all types of people, whether they're, you know, it's people that would, I suppose, you know, it's their first house they're buying, or whether it's, you know, they've got out the market, the top of the market, and they're renting a large house for £2,000 to £3,000 a month. I'm in a nice part of Kent, in the Weald, and I think at the bottom end of the market, you know, the people that would be first-time buyers, they're looking around and they're saying, well, hold on, you know, the prices are ridiculously high. I know you say they're coming down, they are a bit, but at the same time, you know, the lenders have been irresponsible. They've actually caused part of this problem with the credit crunch and everything, lending ridiculous amounts in terms of a mortgage, you know, 5-7 times someone's salary. I mean, you know, if it's going to be a stretch, don't buy, rent. You know, what's the point of not having any money to live on, stretching, and now actually, you know, possibly having your house repossessed. So renting is good, certainly if you're at the lower end of the market.
Alex, thanks for that. Fergus Muirhead, do you agree that we're obsessed with owning, that we see it as the eventual nest egg, better than a pension, some would say?
Well, we certainly have done for the last couple of decades, but can I pick up on something Jonathan said a minute ago, Phil? I didn't misinterpret what he said, and we have to be very, very careful when we use the word facts, because Jonathan's talking about what Nationwide is saying, but I've got a bit of paper in front of me here that says that from the Land Registry, that says the annual rate of increase in house prices continue to slow, falling from 6.4% in January and 6.7% in December. It doesn't say that house prices are falling, it says they're growing slightly less quickly than they have been before. And that's from the Land Registry's figures. So we've got to be very careful that you ask 10 economists the answer to a question and you'll get 10 completely different answers. And that doesn't mean that one is right and one is wrong. People use different figures to show different things.
Nick Cosgrove?
You can say almost anything to prove a point.
I mean, just to come in here, clarify, Land Registry do deal in facts. I think they are the government figures. They deal with the actual prices that have gone through. They are a bit behind in terms of time. I think you'll find that the latest Land Registry figures that came out yesterday actually don't deal with anything that happened in March, probably most of February and January in particular is looking at. But and the Nationwide actually is really a survey rather than actually you know, actual facts on the ground. It's a survey of what people who are buying and selling houses think. So I think we've got to be careful about the figures.
Let's take a pause there for some news and sport, and we'll carry on talking after the news. Jonathan Davis with us, Chartered Financial Planner from Armstrong Davies. Fergus Muirhead, who's a financial expert and journalist. Nick Cosgrove here from 5 Live Money. And we can talk to you on 0500 909 693. Especially want to hear from you if you're a first-time buyer tonight and you've been looking and you're not sure you can even be offered a mortgage to get your first foot on the property ladder. Or I'd like to talk to you if your mortgage deal's about to run out and you're concerned about renewing it with all these institutions withdrawing their mortgages to new customers. What do you think? 0500 909 693. And Rachel Hodges is next with the latest BBC News on 5 Live at 11:31. Jonathan Davis with us, Chartered Financial Planner from Armstrong Davies. Fergus Muirhead's a financial expert and journalist. Nick's here from 5 Live Money. Just talking about the growing number of financial institutions who are withdrawing mortgages. And how many products, Nick, did you say were no longer available today?
Well, 500. More than 500 deals were withdrawn today. And I said that in the last month, the number of mortgages on offer has fallen by 40%. At this time last year, there were 13,000 different mortgage products on the market. There are now less than 5,000.
Trevor's on the phone in Thetford. Hi, Trevor.
Hello.
What's your story?
Me and my girlfriend got into the housing market 2 years and 3 months ago.
Yep.
We got a 100% mortgage with Northern Rock because we didn't have any deposit or anything.
Right.
And our, I can't think of what it's called now. We got a fixed rate for 3 years.
Yeah.
And it comes to an end in it's January. So we're
January 09.
January 09, yeah. So obviously we're coming towards the end of it now. And Northern Rock sent us a letter last week saying that their interest rates would probably be a lot higher than what they gave us at the start of it. So we don't think we'll obviously be able to afford to stay with Northern Rock.
Well, you've got a few months, haven't you? Fergus Muirhead, what would your advice be?
Well, but we're still a long way away from January 2009. There's an awful lot could happen between now and then. I think people have to be aware that I think what happens when people look for their mortgages, by the time they get to look for their mortgage, they've already chosen the house they want, and they don't always concentrate as fully as they might do on the terms and conditions of the loan they're actually looking at. And if you buy something that's discounted for 3 years, then you need to understand that the price of that is going to rise in 3 years' time. And if there's nothing else around about that's cheaper in 3 years' time, then the cost is going to rise. Now that's not good news for people that are coming to the end of fixed rate deals, but that's what happens. And if you're buying something cheap for 3 years that's discounted, then the natural thing at the end of that 3 years is that the price is going to rise if there's nothing else that's cheaper round about in January 2009.
Fergus, thank you for that bit of advice. 0500 909 693 is our phone number. Would have been interesting to ask Trevor, actually, whether they'd made any savings provision. I suppose in the current climate, Fergus, we hear about credit crunches affecting the global position, but in terms of individuals, are people able to save? Is saving a decent idea at this time, or is it something that a lot of us just can't afford?
Well, I think we're seeing daily reports now that the amount of money that people are putting aside into pensions has halved, I think, over the last 12 months, because people are worried about increasing mortgage costs. And I think on top of the increase in mortgage rates, I think Nick mentioned as well the fact that we've got more and more people just borrowing more money from lots of different sources. So I think we do have a huge issue here. And I think what's also happened is people who have seen the value of their property rising over the last 10 years or so have taken chunks of money out of their out of their property as equity to go and do other things with. So they've taken money out, they've increased their indebtedness on their mortgage, which is secured, and they've gone and bought new cars, or they've gone and had holidays, or they've gone and spent that money elsewhere. And I don't think that's been particularly helpful either.
Junior's on the phone in Croydon. Hi, Junior.
Hello there.
What's your situation?
Well, I've just received an offer from Abbey. I'm a graduate, 23-year-old.
Yeah. So you're a first-time buyer?
First-time buyer, yep.
Okay, and Abbey have made you an offer?
Yep, they've made me an offer. I think it's 5.79 on fixed rate for 2 years.
Okay.
And on the property, one-bedroom flat on Oakham Road in London.
Yeah.
I'm a bit worried, really, after hearing the old news of, the credit crunch and house prices and all the old, deals I've been hearing. I'm just wondering whether to pull out now.
Well, Jonathan Davis.
Well, 5.79, as it happens, is a really good rate. I'd be interested to know what the fee is, because I gather these fees these days are about £1,500 to £3,000.
Yeah, the fee was £1,500, yeah.
Well, exactly. So, I mean, over 2 years you can probably add on another 0.75%, which makes it about 6.5%. You look at it, the same property. I will wager you that if that property was available for rent on a monthly basis, you could rent it much cheaper. Let me give you a quick calculation of something that I've done in Hertfordshire, which is close to where I live. Okay. An average 3-bedroom semi is valued these days at £300,000. Okay. And if you borrowed 80%, not 90 or 100, but 80%, that would cost on a monthly basis on a capital and interest mortgage about £1,500 or £1,600 a month. Okay. I can tell you for a fact that the rental cost of those properties is £1,000 a month. That's just the first thing. The second thing is, I said a year ago on the News at 10 with Evan Davis, the then economics editor, that house prices in the UK are going to fall 25% over 4 to 6 years. 6 months ago, I raised the forecast to a fall of 30 to 40%. If I'm even close in getting it right, and I can tell you so far I have been proved right, that £300,000 house is going to go down to 200.
But the trouble is, Junior's looking to buy, he's not looking to rent.
Yeah.
Well, if he's looking to buy because he thinks it's going to give him security financially, it ain't.
It might not now. It might not in 2 years. It might not in 5
Then
years. But
buy,
Junior, this
then
is a
buy
hand.
in 2 years, but don't buy just now.
Are you looking to live in this for a while, Junior?
Yeah, I am looking to live in it in a while.
What's the loan to property value that you're doing?
It was, I think because they're doing a special deal for first-time buyers, I think I put down 5%, which
Right.
worked out to about 8.5%, and I think I'm borrowing 80% of the equity of the property, and I
Right.
think the actual council in Peckham are putting the 20% in.
Fergus Muirhead, what would it be your take on Junior's particular situation?
Yeah.
I have to say that I think Jonathan's made some really good points there. That the first one he mentioned was about the fees, and I think people need to realise that the fees that lenders are charging for what looks like a really good rate top line,
Yeah.
the fees can add 0.5% onto that rate you're charging, as Jonathan was just talking about there. And what happens is you end up paying these. The other thing that lenders do to you is they say, don't worry paying the fee up front, just add it onto your mortgage. So what effectively you're doing is
that's
paying
what
over
it
the
does.
next 25 years.
Yes.
So you're actually paying interest on that £1,500 over the next 25 years. That's a really important point.
So you're better off to try and pay that up front.
Well, if they're going to fight, first of all, make sure that you take the fee into the calculation. Don't just go on a headline rate. Because something looks like a very good headline rate doesn't necessarily mean it's the best deal for you. So I think you have to look at fees. I think you also have to look at the whole question of why people buy. And I think Jonathan made the point about the capital and interest mortgage paying, be costing between £1,500 and £1,600 a month. I think that there's an awful lot of people these days who aren't taking out capital and interest mortgages, who are taking out interest-only mortgages to reduce that monthly payment. Now, effectively, what they're doing is renting their property because they're dependent on capital growth. And even if you don't buy into Jonathan's 30 or 40% price drop over the next 4 or 6 years, even if the market flattens out, then you have to ask yourself whether you'd be better off renting than having a straight interest-only mortgage.
Junior, I hope we've helped you out.
Okay then. Sort of.
I hope you've, I mean, I think, you need to put some proper thought into it from what the chaps have been saying, and let us know. I'm on for the next couple of weeks. Let me know what you decided to do. Give us a call back next week. 0500 909 693 is our phone number. Simon in Crouch End has sent me a text at 85058. Phil, my girlfriend and I are potential first-time buyers in North London. We pay £870 per month rent for our flat, but identical flats are on the market for 250 grand to buy. £870 per month covers a mortgage of about 150,000, which is a 100,000 grand shortfall. Renting is a no-brainer. I can't wait for the crash, says Simon. Adrian, Fergus is absolutely right. The language with which we talk about these things is vitally important. There are many people who are set to gain financially from a possible depressed housing market. You wonder if Jonathan may be one of them. Jonathan, right of reply?
Absolutely. I didn't hear anyone use that argument when estate agents, banks, developers, politicians, Uncle Tom Cobley were saying, isn't house price rises great? Because they were making vast sums of money while house prices rose. Well, the fact is, it's been going up for 10 or 15 years, and it has now stopped dead, and it's now going down.
You are a spokesperson for a website called housepricecrash.co.uk, so is it not in your interest?
I'm a spokesman for House Price Crash Co.uk, not because I necessarily want prices to fall, but because as an economist and as a financial advisor, I believe that they will.
Roy is on the phone. Hi, Roy.
Hi. Sorry, hi.
Yeah, it's okay, Roy, go on.
2 points, if I may.
Yeah.
The second one's specifically with mortgage, but the first, I'm actually sick to death of one by one, trying to frighten us to death with all these stories. I haven't dropped dead with Asian flu. I haven't had my bank account emptied by people stealing my personal details. I thank God it never happened. Happened about 10 times in 3 weeks. Now I've given up on that one. But specifically on mortgages, it makes no difference to 99% of us whether our house is worth 200,000 or 2,000. We don't buy to make a profit. We buy purely so that in our old age we've actually got somewhere to live.
Well,
rent-free.
Roy, you must want some kind of profit, otherwise you'd just...
What am I going to do with it? I mean, if I sold my house, it doesn't matter whether it's 20,000 or 200,000, whatever I bought in its place is going to cost exactly the same. It doesn't matter what the going rate is. I'm not going to make any money out of it. The only thing that I might do is be able to leave some money to my children. But that's not really why people don't buy a house at the age of 25 to think I can leave some money to my kids or make some. They just want somewhere to live where they know when they get older they can live there rent-free because they own it.
Jonathan
the
Davis?
price is irrelevant.
Jonathan?
Sir, you said 99% of people don't care. Well, of course, that's factually balderdash, because 1 million buy-to-let mortgages are out there, and that's 4% of the housing stock in the UK, and 500,000 of them took them out in the last 2 or 3 years. And when you add on top of that all the millions of people who took out mortgages to buy their own property in the last few years, I'll tell you, there's a lot of people out there, a vast swathes of the population, who are very nervous right now because, we know for a fact that house repossessions are rising rapidly.
Very, very briefly, because we need to wrap up. Roy, thank you for your call. I think the point Roy's making is, forgive me for extrapolating from what you've said, but a lot of the messages you've given, Jonathan, appear to be very gloomy and warning of doom and 40% falls. I mean, that's a massive fall you're predicting in property prices. And people are fed up of those types of warning on all manner of stories, aren't they? On medical stories, on financial stories. What would you say to people who have that view? I
would say, just like the first-time buyer callers, I'll tell you, do not touch property with a barge pole right now, because if you do, you'll be financially toast. I'm giving investment advice here, and people should really heed it. It's as simple as that.
Fergus Muirhead, very, very briefly, is the panic on?
No, I don't think the panic's on. I think Jonathan is a bit over the top. I think we just all need to calm down a wee bit. I think residential property, and actually Jonathan said recently, I think he said in an article in The Guardian recently, I'm not talking about your own property, he was talking about investment property. So I think we need to differentiate between investment property and residential property.
Okay. Chaps, thank you very much indeed. We've run out of time, but I'm grateful to both of you for your company this evening. Jonathan Davis, Chartered Financial Planner from Armstrong Davis, and Fergus Muirhead, financial expert and journalist.